Simple steps to review financial statements. Introduction. Recap the key takeaways from Day 2, identifying financial red flags and understanding key areas to monitor. The focus for today is learning how to review financial statements to ensure accuracy and detect potential issues. The importance of regular reviews of financial statements is essential to ensure financial integrity and compliance with regulators. Purpose of financial statement reviews. You should be aware of the purpose of the financial statements to show you your actual financial performance and position. The primary goals of reviewing financial statements for suspicious activities, detecting errors and fraud. Regular reviews help identify inaccuracies, discrepancies, and potential fraudulent activities. Ensuring accurate financial reporting. Accurate financial statements are crucial for decision-making, securing financing, and meeting regulatory requirements. Maintaining compliance. Regular reviews ensure that financial statements comply with accounting standards and legal obligations. By reviewing your financial statement on a regular basis for unusual transaction will help in protecting a business's financial health. Key sections of financial statements. The three main financial statements that are of primary concern include balance sheet, which shows the financial position of a company, which includes its assets, liabilities, and equity at a specific point in time. Income statement, P&L statement or statement of financial performance, that reports a company's revenue, expenses, and profits over a period. Cash flow statement that details the cash generated and used by a business. Areas to look out for. Here are some issues to watch for during a financial statement review. Asset misstatements. Look for discrepancies between recorded assets and actual physical assets. Ensure assets are not overvalued or missing. Liability discrepancies. Check for unrecorded liabilities or obligations that are not properly categorized, such as short-term debts recorded as long-term. Inconsistent profit margins. Compare profit margins over different periods to identify any unusual fluctuations that may indicate errors or manipulation. Operational expenses. Compare actual expenditure against budget and last year. Case study introduction. ABC Services, owned by Mr. Smith, has been running smoothly with consistent operations and steady growth. As part of his routine financial review, Mr. Smith examines the company's balance sheet and immediately notices a red flag. Liabilities have significantly increased compared to the previous quarter. The jump in liabilities is unexpected, as there haven't been any major changes in operations that would justify such a rise. Concerned about what might be driving this increase, Mr. Smith decides to investigate further. He reviews recent transactions and payments, but to get a clearer picture, he reaches out to his employee responsible for handling the company's financial records and accounts. Examples of accounting statement fraud. There are many cases of corporate failures due to irregularities in financial statements. Here are two examples. Lehman Brothers. One of the most infamous cases of accounting fraud is the collapse of Lehman Brothers. This global financial firm concealed more than $50 billion in loans by falsely presenting them as sales. They exploited a loophole in the accounting rules related to repurchase agreements, offloading toxic assets to Cayman Island banks with the understanding that they would later buy them back. Bernie Madoff. In the same year, another massive financial scandal was revealed, the Bernie Madoff Ponzi scheme. Madoff, founder of Bernard L. Madoff Investment Securities LLC, defrauded investors of an astonishing $64.8 billion, making it the largest Ponzi scheme ever recorded. Instead of generating profits, Madoff and his accountants, David Freeling and Frank D. Pascali, used funds from new investors to pay returns to earlier investors. Reviewing the balance sheet. Take a moment to see how you might review and address concerns on the balance sheet. Our liabilities seem higher than last quarter. Can you explain the increase?
We took out a short-term loan for inventory. I updated the records accordingly.
Let's verify that the loan was recorded correctly and is reflected in our financial statements. Emphasize the importance of verifying the accuracy of liabilities and other critical elements on the balance sheet. Steps to review the balance sheet. The key steps to effectively review a balance sheet: check asset and liability balances, ensure that all assets including inventory plus liabilities are accurately recorded and categorized. Compare with previous periods for consistency. Verify AR and AP ledgers. Review the accounts receivable and accounts payable ledgers for fictitious transactions. Verify recorded transactions. Cross-check significant transactions, such as loans or large purchases, with supporting documentation to ensure they are accurately reflected. Review equity changes. Analyze any changes in equity to ensure they align with recorded profits, losses, and owner withdrawals or contributions. Bank and credit card accounts. Ensure that the bank and credit card accounts are reconciled on a monthly basis. Review outstanding deposits and checks. Cross-referencing with other statements. It is important to cross-reference the balance sheet with other financial statements as follows. Income statement. Ensure that net income on the income statement aligns with changes in retained earnings on the balance sheet. Cash flow statement. Verify that cash flows from operating activities align with net income and changes in working capital. Bank reconciliation. Compare cash balances on the balance sheet with actual bank balances to ensure they match. Third-party loans. Compare outstanding loans with third-party institutions. Ensure that the funding received or paid agrees with the increase or decrease in liabilities. Example of finding an error. Here is a practical example of how an error might be identified and corrected. Identifying an error. Mr. Smith notices that the short-term loan was incorrectly recorded as a long-term liability on the balance sheet. Correcting the error, he works with his accountant to reclassify the loan correctly, ensuring the financial statements are accurate. Updating financial statements. The corrected balance sheet is updated, and Mr. Smith ensures that the same error is not repeated in future periods. Summary and takeaway. Recap the key points covered in the presentation. Purpose of financial statement reviews: detecting errors, ensuring accuracy, and maintaining compliance. Key sections to review: focus on the balance sheet, income statement, and cash flow statement. Areas to watch: be vigilant for asset misstatements, liability discrepancies, and inconsistent profit margins. Importance of cross-referencing: regularly compare statements to catch discrepancies early. Let's connect. Contact Peter Adams. Need a professional review? Ensure your financial statements are accurate and compliant. Contact Peter Adams for a detailed forensic accounting review tailored to your business needs. Stay informed and connected. If you are concerned about suspicious activities in your business, let's connect. You can book a complimentary 30-minute session at www.numberschef.co.uk. Follow us on social media and subscribe to our newsletter for the latest tips on forensic accounting, fraud prevention, and financial management.